Let me welcome all of you very warmly this evening to our Peterson Institute for International Economics for the 11th annual Stavros Niarchos Foundation Lecture. This is a program sponsored by the Niarchos Foundation, to whom we are very grateful, which enables us every year to bring a world-class leader, thinker, or both to our podium to discuss a hot issue. Now, this year we were obviously incredibly prescient because we chose the euro as the topic, knowing that there would be some episode of the crisis that would make it particularly timely. And we were doubly prescient by convincing Jean-Claude Trichet to come and be our speaker, since no one, literally no one, could do a more thorough and intense job on that topic than the man who was head of the European Central Bank for the previous 10 years until stepping down last fall. We are grateful to all of you for coming, and we're particularly grateful to Jean-Claude. We do view this evening, both the lecture and particularly the dinner following it, as a tribute to Jean-Claude for the enormously productive, successful, courageous career that he has exercised in his native France, in Europe as a whole, and for the world economy in many, many different regards. So, I will first introduce Andreas Dracopoulos, the co-president of the Stavros Niarchos Foundation, to give a few words of welcome from the foundation. I will then turn to the chairman of our Institute Board of Directors, Pete Peterson, to introduce our speaker for the evening. Andreas.
Distinguished guests, ladies and gentlemen, good evening. First of all, I would like to thank Fred Bergsten for his kind words and for all the amazing work that he has done and he continues to do for this institute. It has always been a pleasure working with Fred, a pleasure and a privilege. Thank you for joining us today for the 11th annual Stavros Niarchos Foundation Lecture Series. It all started back in 2001 with esteemed chairman Alan Greenspan, who's with us today as our first speaker. And 11 years later, the series continues with Mr. Jean-Claude Trichet, who after 40 years of an exceptional career as a public servant, has accepted our invitation to share with us his experiences and more specifically to speak about the lessons learned in relation to this ongoing crisis that the developed world, starting in Europe, is still facing as we sit here this evening. The challenges are great. Sometimes they even seem to be insurmountable. Perhaps nobody knows for sure what we will have to go through until we really recover in a sustainable way. But the crisis will surely become insurmountable if we all continue to be so polarized by sticking to stubborn and fixed views about everything and anything, from global warming, stem cell research, to taxes and entitlements, to deciding either austerity or growth, which, by the way, they're not mutually exclusive, and if well thought out, they both belong in the ultimate solution. This mentality of extreme polarization at the end of the day effectively makes us all unable to really learn any lessons. And the inability to learn and collaborate in trying to find solutions, and yes, sometimes to reach necessary compromises, will certainly make these challenges impossible to address and will probably mean much more pain for all of us and for our children. Institutions like the Peterson will keep playing a vital role in hopefully depolarizing us all. We are thankful to the Institute for making available to all of you this evening our Niarchos Foundation's latest booklet describing our most recent grant-making activities around the world. And without wasting any more time, I'm honored on behalf of my colleagues at the Stavros Niarchos Foundation and Spiros Niarchos, who is here with us tonight, to welcome the Honorable Public Servant Jean-Claude Trichet. Hope you enjoy the evening. Thank you for all joining us tonight, and Pete will do the formal introduction. Thank you.
Before I say a few words about our guest of honor, I would be deeply remiss if I didn't say a few words about Fred Bergsten. as you probably know, he's decided to retire from his position as executive director of this institute. But thank God he is going to stay as a senior fellow and do research and writing. And Fred, my mind goes back to nearly 32 years ago when you and I were refugees or victims of the Nixon administration. And I was President Nixon's assistant for economic affairs, and you were Kissinger's economic advisor. And when we got out of those positions, we were lamenting the fact that in spite of the obvious growth in importance of international economics, not only in economic matters, but in foreign policy matters, there was no important place within the United States where this had deep capabilities. At that point, we joined with Frank Loy of the German Marshall Fund, who wanted to build something in the United States out of gratitude, perhaps, for what America had done for them. And this small institute was started. 32 years later, I got great satisfaction, and I hope you got some pride, Fred, of seeing that a British magazine asked a large panel of experts which are the best think tanks in the world. And this relatively small institute was picked number one from hundreds or thousands, I guess, Fred, of think tanks. Now, I think you test the outer limits of compound probabilities. And let's indicate what I mean by that. You are extremely good substantively and in defining a creative agenda that gives us a comparative advantage. You're supremely good at attracting the very best people, and not only attracting them, but keeping them. We've had remarkably little turnover here, it seems to me. You're very good at outreach and communicating the results to the relevant audiences, the Congress and the public at large and business and so forth. How many corporations do we have now that support us? 150 different corporations, just a remarkable piece of work. And I always used to needle Fred that I didn't want him to forget this trivial subject called fundraising. And he almost carried it too far. I reached the point where I was terrified to approach him because his capacity to get into my pocket, even when my hands were in my pocket, was simply extraordinary. So I could go on and on about the combination of qualities, but I consider you, Fred, a 1 in a million head of a organization like ours, and you ought to be very, very proud. And if I may prevail on you, if anybody deserves a standing ovation, it's Fred Bergston, and I'd like to get that.
Thank you all very much. Deeply appreciated. Thank you.
I used to say to Fred that total compensation is made up of financial compensation and psychic compensation, and that we were very good at psychic compensation. We weren't nearly as good at financial compensation, and he's been able and willing to accept a modest income for somebody of his talent. Well, back to our program this evening. We at the Institute, again, want to thank the Niarchos Foundation for making all of this possible. We're either, as Fred indicated, extremely prescient or very lucky. I say there's two kinds of luck in this world, smart luck and dumb luck, and I'll take either one. But we choose to think that Fred was prescient in this case. Nor could we have gotten a more knowledgeable speaker than Jean-Claude Trichet. He, of course, played a decisive role in the Europe crisis. as president of the Europe Central Bank until he stepped down last fall. This was only the latest episode in Jean-Claude's remarkable career as a top economic policy thinker in France, in Europe, in the Eurozone, and in fact, the world economy. Jean-Claude began his career at the French Treasury and rose to become director in 1987. During that period, he played a lead role in steering France toward its exchange rate policies and restored the country's economic strength and stability. He had continued these efforts as governor of the Bank of France for 2 terms, which he did from 1993 until 2003. While in that position, he prepared a pivotal role in the creation and the euro of the euro itself, and was a member of the convening Council of European Central Bank from the outset of the new currency. He became president of the ECB in 2003 and ended his single 6-year or 8-year term last October. Jean-Claude has received so many honors and accolades around the world that I cannot begin to list them all. They are given in your program. Most important, of course, has been his role as a member of the board of directors of the Institute. I thought that was rather funny, but apparently not. He's been a director since 1998. It is a great pleasure and an honor to introduce Jean to you to give this year's Niarchos Lecture. Jean-Claude, welcome, sir.
Thank you so much. Thank you very, very much indeed. I must confess it's an immense pleasure and a very great honor for me to be there with you, Pete, with Fred, and I have to say with all the friends that are here and are your close friends and also my close friends. I have to say I am very moved to deliver the lecture for the Stavros Niarchos Foundation. I understand, Pete, your family is coming from Greece. The Stavros Niarchos Foundation seems to me to be close to Greece too. And when you were speaking of lucidity or extra lucidity in choosing the issue for this lecture, I have to say that you really were very lucky, as you said. I don't know whether it's good luck or the kind of luck you were mentioning, but Greece is at the very center of global attention today. And I will try to put in perspective part of what we are observing at the very moment. I would also say that it's an immense pleasure to be here with Fred. I know Fred. I have been knowing Fred since a very long period of time, since you were involved in the G5 meditation, very old times, obviously, where we were speaking of the G5 and not the G7 or the G10 or the G20 or more. And my memory is that we have been in very close contact, particularly in the occasion of all the crises that we have experienced at a global level over the last 25 or 30 years, because we are experiencing a crisis in the advanced economy since 5 years, but we were together in the crisis of Latin America and in the crisis of Africa and in a number of other crises. I always appreciated enormously your lucidity, your imagination, and we shared at certain moment imagination to try to get some advance of in the I would say international community of new concepts, and your fantastic energy, which is legendary. As I said, we have witnessed together the Latin America crisis, the African crisis, the Middle East financial crisis, culminating with the Egyptian bankruptcy in the 80s, all this in the 80s, the Central and Eastern European crisis culminating with the Polish collapse, the Soviet Union financial crisis culminating with the Soviet Union dislocation at the end of the 80s and the beginning of the 90s, the Asian crisis at the end of the 90s, and the advanced economy financial crisis since mid-2007 with a number of episodes. And now we are in this particular episode where the European Union, and more particularly the Euro area, is the epicenter of the present episode of the crisis. If we put the present crisis in this perspective of the 25 or 30 last years, the fact that the advanced economy were hit starting in 07-08 is less surprising. They were practically the only ones that were spared from adjustment since World War II. Practically all the other countries and economies in the world were hit earlier. In a way, it was their turn. And I have to say, what a dramatic turn. It reminds me, I'm speaking in front of previous chairman of the Fed, and Don, who's here. I remember Ben telling me at the moment where the epicenter of the crisis was crossing the Atlantic, at the moment where we were, I would say, starting to experience the crisis of the sovereign risk, Ben put his finger on me and said, "Now, Jean-Claude, it's your turn," which was a very good summing up, unfortunately, of the situation. And it was at the end of 2009 and at the beginning of 2010. I am personally convinced that these 2007-2008 initial shocks were potentially graver, even graver than those which triggered in the 29 crisis. And had the central banks and the public authorities not embarked on prompt and decisive actions, I trust that we would have experienced not only a great recession, but a dramatic, deep, and rapidly unfolding depression that would have been again graver than in 29. That is my personal understanding of the situation we had to cope with. But the central banks and the public authorities embarked on prompt and decisive actions. And by public authorities, I mention not only the states and I would say, main participants in the international community and also the international financial institutions. Let me say that I would concentrate my own exposition, if you permit me, and you will have a written paper that would be a little bit longer, but I want to let some time for the questions. And I understand, Pete and Fred, that it is your intention to organize some question and answer session. But let me only say that I will first concentrate a little bit on monetary policy in the crisis and the so-called non-standard measures, which were part of this prompt and, I trust, decisive action that the central banks had to engineer in order to cope with this extraordinary crisis. And second, I would concentrate on the euro and the future of European economic integration. Let me say on this particular issue that it reminds me the fact that we are so numerous here to listen to what I have to say on the euro in particular, remind me the story in 1996 of this European academic that was invited in the United States of America to participate in a colloquium on the euro. At the time, you know, the euro was not interesting. It was not the fashionable issue. So he was a little bit surprised, nevertheless, to see that at 9 o'clock, which was the supposed start of the colloquium, there was absolutely nobody in the room. So he waited a little bit. 20 minutes afterwards, one person entered, and he understood that he could not expect much more audience. So he had prepared his own exposition. He had a lot of slides. He embarked on a 1-hour exposition, and he got meager applause, as you can imagine, and he was repacking everything and leaving the room when the guy in the room said, Sir, don't leave the room. I am the next speaker." Well, as I said, it's much more fashionable for very bad reasons, obviously, today. But let me first say a few words on the unconventional measures. The widespread introduction of so-called non-standard monetary policy measures by major central banks has been a defining characteristic of the global financial crisis. Across central banks, there has been no standardization of non-standard measures. Approaches are distinct, tailored to their respective economies and their structures. We have seen enhanced credit support, credit easing, quantitative easing, interventions in foreign exchange and securities market, and the provision of liquidity in foreign currency. And let me say in front of Alan and Paul and also Don that we have enormously appreciated the cooperation between the Fed and the European Central Bank at the heat of the crisis. The cooperation, the fact that we could have an agreement and a swap agreement to issue ourselves dollars in Europe, of course, at our risk and with the appropriate collateral that we were controlling ourselves, but has played a decisive role, I trust, at the very moment where the global crisis was culminating, the financial crisis was culminating. So again, a very, very, very profound thank to the Fed in this occasion. By the way, I think that without the mutual confidence that the major central banks had at all levels, I would say staff level and top level, has been decisive, I trust, in the handling of this crisis. And I think that it is underestimated, that degree of mutual confidence. Anyway, these non-standard measures have been used to support the functioning of the financial sector and to prevent the real economy from the fallout of the financial crisis as much as possible, and also ultimately to preserve price stability over the medium term. There are two distinct views on non-standard measures. Some view the non-standard measures as the continuation of standard policy by other means. Once nominal interest rates cannot be lowered further, central banks use other tools to determine the monetary policy stance, that is to contribute in the desired way to economic, financial, and monetary developments. To illustrate this view, I would compare it to, once the end of the road has been reached, engaging the four-wheel drive. Central banks expand their balance sheets and inject liquidity so as to influence the structure of yields and returns and thereby stimulate aggregate demand. This approach would be broadly in line with the theoretical analysis and prescriptions of Friedman, Tobin, or Patinkin. The logic of this approach is essentially sequential. First the standard measures, then the non-standard measures. If this sequential logic were also to be applied to the exit, it would essentially mean unwinding non-standard measures first and subsequently raising interest rates. Let me suggest a different view of our non-standard measures. Say that key interest rates are to be set at levels we consider appropriate to maintain price stability, drawing on our regular comprehensive assessment of economic and monetary conditions. In other words, in this perspective, policymakers would follow standard practice in this regard. Their interest rates can be more or less significantly positive, close to zero, or at zero level on the basis of this analysis. But whatever the level of nominal interest rates, on several occasions, particularly in time of acute crisis, The monetary policy stance established in this way faced obstacles in being transmitted to the economy. During the financial crisis, market functioning was impaired, at times very profoundly. In response, one might act to overcome some severe malfunctioning that was hampering the channels of transmission of monetary policy. In this perspective, non-standard measures would be introduced to help restoring a more effective transmission of our monetary policy stance to the wider, in the case of Europe, the wider euro area economy. Staying with the image of the road, I would say that the metaphor suggests to remove the major roadblocks in front of us so that the policy stance could be transmitted to the economy in the intended way, whatever the level of interest rates would be. The logic of this approach is therefore parallel and supportive. This logic has a potentially clear implication for the exit. In this perspective, we can determine standard and non-standard measures very largely independently of one another. Policymakers will not be bound to unwind non-standard measures before considering interest rate increases, or to put interest rates to the zero lower bound before considering the introduction of non-conventional measures. In this perspective, it would be legitimate to take those decisions independently. One set of measures, the so-called standard ones, depends on the medium and long-term outlook for price stability. The other, the non-standard, depends on the degree of dysfunctioning of the monetary policy transmission through the financial system and financial markets. With this overview of a guiding principle in mind, I would like to discuss perhaps a little bit in detail what is at stake in this area. I have to say that the changes in the ECB's key short-term interest rates, the so-called standard policy measures, have remained the key instrument of monetary policy in the euro area, and I trust that the Governing Council has always put the rates at the level which was deemed appropriate for the delivery of price stability over the medium term. I would say that two issues are worth particular attention. First, the close relationship normally observed between the key policy rate and short-term money market rates assumed a more complex form during the crisis. And it was important to recognize that in times of crisis, a broader set of market interest rates extending beyond the very short-term money market rates was relevant in signaling the monetary policy stance given the segmentation of financial markets. The second point I would like to highlight concerns the question of forward guidance or pre-commitment regarding the future path of key ECB interest rates. There are the sentiment in various places that we are in two different conceptual schools on the two sides of the Atlantic. And I don't trust that it is really the case. I think that it is almost entirely a question of semantics and of presentation. One school stresses the central bank view on the probability of realizing a certain path of short-term interest rates over a considerable period of time. For instance, the high probability of having very low interest rates until 2014. The second school stresses the importance of preserving price stability over the medium and long term in line with the definition given by the central bank. In this second concept, one also stresses explicitly the goal of having a low path for an important other indicator, namely the stability of low, medium, and long-term inflation expectations in the years to come. There is no doubt in my mind that the commitment on low interest rates for a considerable period of time is conditional. Nobody would trust that interest rates can remain very close to zero level or at zero level, whatever happens over a period of several years. By the way, I have to say that it's always underlined by the central bank of the first school, if I may, particularly by the Fed, that the commitment is not unconditional. It's been said very clearly by Ben in many occasions. And it goes without saying that when one stresses the stability of long-term inflation expectations over time, it means that the interest rates of the main refinancing operations of the central bank of the second school, say the ECB, would be designed to deliver this stability, taking into account the changes that might occur in the economic and financial environment. So in both cases, short-term interest rates can move and should move depending on circumstances. We have, as you know, on our sides of the Atlantic, a preference for the second school posture of no medium-term pre-commitment on interest rate. But again, as I said, I don't trust that it is a real conceptual divide. I think it's a question of how you present more or less the same overall goal, which is to pursue nominal and real interest rates favorable to growth, which is, of course, depending on the nominal interest rates. And when you are pursuing a low level of inflation expectations over the medium and long run, you are paving the way for low, medium, and long-term nominal rates. Now, let me mention a little bit that standard monetary policy proved obviously insufficient in the very challenging context of the financial crisis. I already said that we had considered that standard measures and non-standard measures should not be coupled in our own case. And as you know, we have obviously had the 9th of August 2007, we embarked in the first non-standard measure that were, in the case of the Central Bank of Europe, really this unlimited supply of liquidity at fixed rate, at different duration, and provided, of course, appropriate collateral was presented. At that time, it was a very short duration. It was a 24 hours duration, but it was unlimited supply of liquidity at an interest rate which was 4.25%. It was the interest rates that was the main refinancing operation rates, the 9th of August 2007. And so clearly, our first try of non-standard measure was particularly clearly not associated with a zero-bound level of interest rates, but again, as a very substantial one. So it was the best illustration I can offer at the very beginning of the non-standard measure of the way we are looking at it. Now, I have to say that the non-standard measures, as far as we see it, I see it, are, of course, something which is very abnormal, obviously, and that must be associated with a number of conditions. And I will go very rapidly on that, but I think it's important to realize that if they are not very carefully monitored, the non-standard measures might have themselves the unintended consequence of creating a financial environment which could be abnormally benign for private markets, for commercial banks, and of course, particularly in our case, for sovereigns. This, in turn, could contribute delaying the necessary improvements in rules, regulations of the financial sector, balance sheet repair of financial institutions, structural reforms of the various national economies, and, of course, fiscal adjustment. This is true, I will have to say, in all advanced countries, and it is particularly true in the European case. That's the reason why it seems to me that non-standard measures must satisfy the 5 following conditions. First, they must be as precisely commensurate as possible with the degree of dislocation and disruption of market they must contribute to counter. It's, of course, always a matter of judgment. And it calls for judgment, an initial diagnosis which would be as lucid as possible. Second, the measures must be accompanied by messages as forceful as possible to commercial banks to urge them to address resolutely their medium-term recapitalization and balance sheets repair issues. To the extent that banks are by far the main instrument utilized for the non-standard refinancing in the case of the ECB, this message is particularly important in Europe. This calls also for the messages of the central bank to be fully understood and correctly transmitted by the supervisory authorities in each particular jurisdiction. I have mentioned the fact that the non-standard measures were of a different nature in the US and in the euro area. The reason is very, very simple, and it's a clear-cut, it seems to me, very convincing explanation. In our case, the financing of the economy is made by commercial banks with the proportion before the crisis of approximately 75% against 25% financed by the markets. And it's not surprising, therefore, that we have concentrated our non-standard measures on the commercial banks. In the case of the US, it is exactly the reverse. Before the crisis, the financing was done by the markets in the proportion of, say, 75 to 80%, and the banks for the rest. And of course, not surprisingly, the non-standard measure of the US Fed are concentrating on markets. And we are both, I would say, combating what could be the worst possible case. In our case, the, I would say, sudden stop of the functioning of the commercial bank channel to finance the economy. In the US, the sudden stop of the markets themselves to finance the economy. And we know that it is not only theory, but also at times of very acute crisis, a risk which could have materialized. Third, conditions, the measures must be accompanied also by clear and unambiguous messages when and where needed to the countries themselves. When the non-standard measures are necessary, in particular because of disruption of markets due to loss of confidence in the sovereign signature, the messages must be as clear and quick as necessary in order to avoid the failure of the measure themselves and or the creation of an artificial environment that would pave the way for major additional difficulties in the future. A case in point would be the messages that were sent in August 2011 by the ECB Governing Council to several governments in Europe, and the messages sent in the most recent experience of the so-called 3 years LTRO to all governments in Europe. Fourth, in the case of Europe, an additional condition would be to ask the European institutions as well as the governments to embark collectively on a significant improvement of their economic governance, what I call myself the quantum leap in improving the economic governance. I will go back to that. And it is absolutely clear that this was one of the very strong messages that the central bank had for the European institutions, namely for the Commission and for the Council, namely the government as a grouping. And fifth, I think, I trust, and I dare say that in front of the Fed representative, the previous chairman, I think that a last condition remains very important to the extent that the combined non-standard measures of the central bank of the advanced economy are creating at the global level a very substantial structural change in the monetary and financial environment of the global economy. It seems to me necessary for the full constituency of central banks to call for the appropriate reinforcement of global governance, not only continental governments as in Europe. As long as the non-standard measures are considered necessary by central banks, I'm convinced that they are entitled to be the most vocal advocate of the necessary reforms of global finance and the necessary adjustment of global imbalances through appropriate changes of the macro policies within the framework of the G20 and with the decisive contribution of the international financial institutions. I have to say, and I don't want to embark more on that, that the decisions which was taken by the ECB as regard the last LTRO meets all the 5 conditions I have mentioned. It was commensurate to the gravity of the disruption of markets, and all the other conditions I have mentioned were there too. So I have absolutely no doubt that this was an appropriate decision to take. I mentioned, of course, the fact that these conditions, these messages, are part of the decision which was taken. Now, I have to say that I don't want to embark too much on some kind of meditation on what exactly is happening, but I draw your attention, and we are in a sanctuary of meditation, if I may, here, economic and financial reflection. And it's hard to imagine a better place to open up avenues for reflection. For me, it's absolutely extraordinary that the major central banks of the world, all the major central banks of the world, have, at the present moment, at the moment I'm speaking, embarked in non-standard measures that had the consequence of augmenting considerably their balance sheets. I had the computation of some metrics to understand exactly what is the volume of this new intermediation which is done by central banks in the US, in the UK, in Japan, and in the euro area. The figures I have as regards the volume in terms of percentage of GDP of the balance sheet augmentation, which is due to monetary policy. I found since the start of the crisis, say pre-Lehman, up to now, an increase of around 10% of the GDP, 10% of the GDP for the ECB, 12% of the GDP for the Federal Reserve, something like, I would say, 12% also for Japan. The volume, the overall size of the balance sheet are not the same from country to country. Some, like Japan, had embarked in non-standard measures long before us. Others have a big capital and own funds, which is the case of the ECB. Others have no real big capital. But all taken into account, we are more or less in the same situation, with more than 10% increase of the intermediation by central banks in all advanced big economies. And so we have to try to understand better what it means exactly. And I have to say the most striking observation is that it seems that it is something which is considered now very likely to stay for a certain period of time. I don't know whether I can use the word considerable period of time, but it is more or less what is understood and accepted more or less by observers. So it remains strange, obviously. Nobody had imagined that it could be the case, ex ante. There was absolutely no model suggesting that at a certain moment we would have to substitute to a normal functioning of the private sector, which is obviously the case. And what is even more striking is that it is an observation that you can make in all big advanced economies. So I was mentioning the fact that all other economies had to, at a certain moment, to adjust. We have to adjust. But one of the consequences of this stress in which we are all placed, obviously, is precisely that the central banks are in that situation. I don't want to, again, do anything but opening up avenue. We have two major explanations, and I hope very much that the first explanation would appear to be the right one. In this first conjecture, which has to be proved, we would be experiencing a transitory phase in the advanced economy as a whole. We need now a significant level of non-standard measures to give time to the other partners, and I mentioned the other partners when I listed the conditions, the private sector, the sovereign themselves, and governance at the continental level and at the global level. So we are letting them the time to adjust and to permit the exit. Another explanation, which I don't like at all, but which I feel might explain why it is such a long period, because after all, the crisis started 5 years ago, and Lehman Brothers is already something which happened a number of years ago. Maybe we are now combating an emerging property of the new global financial system, which we have to better understand. Perhaps there are the possibility of tail risk, of total disruption of the system, provided some conditions are met, as we have observed, obviously, immediately after Lehman, where we had an immediate, grave and immediate threat of collapse of the entire system, or more recently in Europe, at the moment where the ECB had to step in, because there was, again, the grave and immediate threat of a sudden stop of the functioning of our banks. So this new systemic risk were not observed before. And I hope very much that we will prove that it was only because the macro policies were not correct, because the imbalances, and I know, Pete, to which extent you yourself are pointing the finger on imbalances, domestic and external, and that provided all these imbalances are corrected, provided rules and regulations in the financial sphere are correctly designed, we would eliminate this risk. But there are other theses according to which the level of interconnectedness between all participants, financial institutions, market participants in general, has dramatically changed with technology and with globalization, and that therefore we have new tail risk that are calling the central bank to play a new role. And again, as I said, I hope very much that this conjecture would prove wrong. But this is something on which we could work, and we have to work, obviously, because we have to understand better what happened exactly over the last 5 years. Now, let me say a word on the European integration and the future of European integration. And consider that it is a way to open up the floor for discussion. First of all, I have to say that the EMU, Economic and Monetary Union, is an acronym which means, again, an economic union on the one hand, a monetary union on the other hand. There is a tendency to confuse the two concepts. And I think it's wrong, because then you don't understand exactly how you can have a solid currency at a moment where you have such problems of financial stability at the level of the sovereign and by way of consequence at the level of a number of financial institutions. On monetary union, I dare embark on a thought experiment. Consider that if I was not making an éloge of monetary union, you would probably be very, very surprised. So I'm sure that you will forgive me to tell you the following. Had I told you at the invitation of the Peterson Institute in 98, say at the end of the first quarter of 98, the euro will be set up in time and without technical problem, I guess that 50% of the audience would have trusted me and 50% would not, because it was very, very frequently argued that it was too bold and that even the technical aspect of the monetary union were much too bold. Had I said that 13 years after the setting up of the euro, 1st January 99, there would be 332 million people with the euro and 17 countries, I guess, I dare say, that only 10% of the audience would have trusted that it would be possible. But 90% would have said, he's dreaming. 332 million is more than the US. He's dreaming. He's very involved, of course, but he's dreaming. Had I said that the price stability would be delivered at the level of 2.03%, I guess that 1% of the audience would have trusted me, and the other one would have said, okay, he's a central banker, he tries to be as convincing as possible, but it's, of course, a dream. Had I said that it would be better than any big central bank, including the Bundesbank, over the last 50 years, it would have been considered possible by 0.05%, a fraction of a person. And again, had I said that the same price stability would be considered credible by markets for the next 10 years. And the same, or even less, a fraction of a small fraction of 1%, if I had said that 13 years afterwards, the exchange rate would be higher than the introduction rate with the US dollar and the sterling pound. And I don't make an argument on that, I only mention that. But I would certainly not suggest that because we are in a floating exchange system. But it is what I observe today. Had I said that all this was still observed 5 years after the worst crisis ever since World War II, 0% would have said that, and even me, I would certainly not dare say that 5 years after the start of the worst crisis since World War II, we would be in such a situation. So I don't say that to be complacent, I don't say that to I would say, suggest that we have no problem. We have enormous problem. All of us, and particularly us, the Europeans, enormous problem. But have that in mind. Have that in mind nevertheless, because we are permanently plunged in an environment which is a little bit biased, which I can understand because all this is very bold. And the proof of the matter is that this thought experiment shows to which extent it was bold to say that. Now, let me also mention 2 points that are totally ignored, but might be of some interest in the real economy side. Since the setting up of the euro, 1st January 1999, do you know what is the level of growth per capita in the United States of America and in Europe? I will give you, per capita. 0.8% in Europe, euro area, 0.6% in the US. Not entirely fair because growth was very buoyant in the US over the 90s, and of course the period is not fully comparable. But I have a tendency to compare because it is very often said it's because of the euro that you're growing so miserably. So let's take the start of the euro. And fortunately, nobody is, some are standing up, because I would say you have to stay on your chairs when I mention a second set of figures. Do you know how many net jobs were created in the euro area and in the US since the setting up of the euro? Euro area, 14.5 million until the end of last year, so taking into account the crisis. United States of America, 8.5. So I was so surprised by the figure myself that I called upon you to check 1st January 1999 up to end of 2011. I was very surprised. So only to mention things that are also illustrating the fact that we don't see exactly what is behind. But I said I don't want to be complacent. Part of the results in per capita computation comes from the demographics in the US that are much better than in Europe. And it is an asset for the US, and it is a liability for Europe. That is absolutely clear. And for the job creation, again, job creation in the 90s have been fantastic in the US. So it's not totally abnormal that there has been some relaxation since the setting up of the euro. But I draw your attention to the fact that it is not known. Nobody knows that. If you would, ask people, and not people in the street, but the people in the main street, but people that are very enlightened, they would not even imagine that it is the case. So again, we have to understand that we are in a universe which is a little bit biased. But that being said, we are the epicenter of the present crisis of sovereign risk. And I would say that economic governance has been very poor and miserable, and has proved in the crisis has been constantly behind the curve in Europe. That's the reason why we have asked ourselves, and I personally, on behalf of the ECB, asked for a quantum leap on the euro area economic governance since the very beginning of the crisis. I could sum up the bottom line in 3 propositions. First, economic governance was relying since the very beginning only on one pillar, the Stability and Growth Pact, with fiscal rules, monitoring and surveillance of fiscal policies, and not on another necessary pillar, namely the close monitoring and surveillance of competitive indicators, domestic imbalances, and nominal domestic price and costs evolution. And I have to say that this is, in my opinion, absolutely of the essence to have the second pillar, which is now in theory in the so-called new secondary legislation of Europe. Second, even the first pillar, the first single pillar, the Stability and Growth Pact, insufficient in itself, had been under attack of the major countries as soon as 2003, 2004. And I say sadly that at that moment, France, Germany, and Italy were in the same very, very bad camp, namely try not to observe the Stability and Growth Pact. And third, there was no crisis management tools envisaged ex ante, nothing at all. That is not surprising, very unfortunately, taking into account the generalized benign neglect demonstrated by advanced economy and the international community as a whole as regards the candid belief that the creditworthiness of advanced economies' sovereign signature was not challengeable. And I have to mention that this was really the mainstream consensus, to the extent that the international, I'm speaking under your control, dear friend, the 2 successive managing directors of the IMF, Rodrigo de Rato and then Dominique Strauss-Kahn, were told by the international community, we don't need now any lending wing in the IMF. There is no point. Private markets, private sector is there to finance sovereign. Let's concentrate on surveillance. But we do not have to continue to have a lending wing, and it is only because the union of the IMF are much too powerful or influential that it has not been done already. This was said until the start of the crisis and continued a little bit after the start of the pure first episode of the crisis after 2007. So I don't say that to, I would say, suggest that the Europeans were in good company as regards absence of lucidity, but I mean, it is the fact that the entire international community had not foreseen what could happen in the 2007 and 2008 years, not at all. And again, this is something on which I know you are working a lot here in Peterson. And third, I would say also that it is now fully recognized that crisis management tools are necessary and that they have to be up to the timing of markets, and that what we had to do was to set up the crisis management tools through 17 democracies and fully respecting, of course, the time of the democracies, which is not at all the time of the market. Now, let me concentrate on one point which seems to me absolutely decisive. When I said that we should go further in the direction of a quantum leap of governance, which I trust necessary for the next step of European integration, I think really that it means that in case, both I would say, for the fiscal policy or for the economic policy having an impact on the competitive indicators, in case a particular country does not apply the recommendations which are coming from the center through the Commission and the Council, and it appears that it is impossible for that particular country to proceed, whether it is the will of the government, of the executive branch not to proceed, or the will of the parliament not to proceed, then it seems to me we should have the activation of a federal governance by exception. Not this kind of governance that you would expect all time for all countries, not at all. Highly exceptionally for one country which cannot do the job. And there it should be in the treaty so that it would be fully democratic, that in that case, after a judgment made by the Commission and a judgment confirmed by the Council, by the other countries, that, I don't know, that particular decision should be taken, for instance, augmentation of VAT of X%, or in case there is an extraordinary dangerous move of nominal evolution, blockade of such and such nominal evolution, that would have to be approved by European Parliament, so that you would have a full democratic backing at the level of representative of the people. But I would say with full legitimacy, representative of all people of the euro area, because they would all be at stake if there are aberrant policies pursued by one particular country with an influence on all others. For me, it is not something which is of a different nature in comparison with what we have already, because what we have already is that in case that particular country is not applying the recommendation, it has to pay a fine. So it is something which is very, very at the limit of what you can accept. Your parliament is not behaving properly, we fine the country because the parliament has not voted the appropriate measures that are necessary for country X or country Y to be in line with what is judged by all Europe appropriate, not only for the country in question, but to protect the rest of the interconnected set of countries that are making up the single market with a single currency. So I trust that this is something which we should be aiming at. And of course, we have under our eyes the hard way to learn the lesson also, because we see to which extent it might be in certain cases complex to be sure that we are protecting the full set of countries that are member of the single market with a single currency vis-à-vis a country which has real difficulty to take a particular decision, a particular set of decisions. This idea of activating some kind of economic, not only fiscal, economic and fiscal federation by exception seems to me not only necessary in the light of the present experience at the level of the, I would say, new step that we would have to do to be sure that we have a solid European Union and a solid euro area. I trust it might also appear as something which would fit with the very nature of Europe in a longer run, because I don't trust that Europe is very likely to have an immense budget. And I don't think that the budget of Germany is likely to shrink, the budget of France likely to shrink in order to make the room for the budget of Europe as a whole. And so it seems to me that this idea that you let the various countries free to behave as they wish, provided they have the respect for a number of rules, but that there is always the possibility of activating the European democracy, and particularly the European Parliament, not only the Intergovernmental Council, if I may, but Commission, Council, and Parliament. And I think that this, I would say, solid democratic anchor is extremely necessary in the present period of time. I must confess that as President of the ECB, and now Mario Draghi is after Wim Duisenberg, we all are doing the same. When we go to the Parliament, very often, at least 6 times a year, to explain what we are doing and respond to all questions. Since the start of the crisis, it is in the European Parliament that I could feel the best spirit of Europe, the best dedication for Europe. There is really there an entity which, in my opinion, stands ready to act and take the decision that I was just mentioning with, again, full dedication for a superior interest at the level of the full body of the countries concerned. So I would stop there, Pete and Fred, and thank you very, very much indeed.